Right. All right, so today we're going to talk about distributions to shareholders. So you've developed a great company, you've got profits coming in, and at some point your shareholders are going to say, we would like some of that profit coming to us, we would like a little cash, or you're going to decide you have too much cash in your bank account, you don't need it for business operations, and you want to distribute that. Distribute that in the form of dividends or repurchasing shares. We'll talk about both of those tonight. We'll talk about, I'm going to give you the overview, theories of what investors want. Do they want dividends consistently? Do they not want dividends? Do they want you to repurchase shares? There's some theories that have statements about that. We'll look at a model, residual model, used to calculate how much you might distribute in dividends. We'll think about the signaling effects. If you give dividends, what sort of signal does that send to the market? If you repurchase shares, what sort of signal does that send to the market? We'll do some math examples, one with dividends, and the other with stock repurchases. Think about how that mathematically affects the share price. We'll talk about stock dividends and stock splits. And at the very end, we'll talk about dividend reinvestment plans, which is if a company gives you dividends and automatically reinvests that money for you. So let's start with the investor preferences. Actually, before we do that, let's go back to a graph that we've looked at before. This is similar to the value graph that we've looked at several times before. And this is the point where we're calculating the free cash flow. And remember, we want a pre-debt figure. So this is cash available to both the debt holders and the equity holders. Question is, what do you do with that free cash flow? If you don't have anything to invest it in, any projects, then it could go to the debt holders. It could also go to the equity holders. We mentioned last week you could purchase different assets that don't have operational value, but they just have value for some reason. We even mentioned that if you have a lot of cash on hand, you might think about a merger. You could spend that money investing in another company rather than giving it back to your investors who have to pay taxes on it immediately. But these two are the things we're going to concentrate on now. The dividends you might pay to your equity investors and the stock repurchases, which would be similar to paying interest and paying principal repayments on debt. So, distribution policy, how you as a company decide how much cash you're going to give your investors, involves three components. One, how much cash you want to give your shareholders. Two, the form of that distribution, whether you want to give that in dividends or you want to repurchase stock. And the stability of the distribution, whether or not you want to consistently give dividends, or whether or not you want to give dividends every once in a while. Three things you need to think about. And we'll talk about how each of these examples works into the stability, the type, and the level of distribution. Patterns over time. I believe your textbook mentioned that about 26 to 28% of net income is typical amount of distribution. So as a company, if you earn net income, say $100 million, trend is that the market, the investors have come to expect approximately 26 to 28% of that distributed to them. That is the norm. That's certainly not what you need to do, certainly not what all companies do all the time, but that's something that's a very important part of income for investors, and getting those cash distributions is something that we need to be aware of as we study finance, of course. Dividend payout rates have fallen, stock is the rage, so stock repurchases are more common these days than dividends. There used to be a time when dividends, consistent dividends, was much more common, but much more common these days for companies to distribute cash via stock repurchases. Dividends have gone a little bit out of vogue with a lot of startup companies, a lot of companies that don't want to get in the habit of paying dividends consistently. They've generally distributed cash in the form of repurchases rather than dividends. Dun, dun, all right, dun, dun. Smaller percentage companies, as I said, young companies usually distribute in the form of repurchases. Dun. Dividends are smaller, more mature firms for the most part. All right, theories. Theories of dividend payouts. We'll discuss 3 theories of what investors might like in terms of these distributions. First, dividend irrelevance, that is that investors do not care whether or not you pay dividends. Second theory we'll talk about, dividend preference, which means the investors want the dividends, cash in the hand, bird in the hand. Third is there is a tax effect, and investors want a low payout, meaning they do not want dividends because they do not want to pay taxes on them. So let's talk about each of those 3, starting with the dividend irrelevance theory. So this is the theory that investors don't care. So you're a company, you have cash to give your investors. You could give them dividends, or you could just hold the cash in your company and reinvest that in the company. And if your investors want cash, they could sell stock. So investors want cash, they could just sell stock. Investors want cash, they could wait for you to give them a dividend. If they don't want cash and you give them a dividend, they could just buy more stock. Does that make sense to everyone? Investors don't care. Question, Greg?
Well, I think investors do care, actually, because if you look at most mutual funds, for instance, the one board that I'm on, we have basically $900 billion in assets under management. Our largest fund is called Rising Dividends, and where they paid dividends for the last 20 quarters. And so we find that one is really one of our best-selling funds. So I think there is a core out there to kind of look at this as fixed income, basically, because they're going to get dividends on a regular basis if they invest in that particular fund.
Okay, so that brings up a couple of things. Sometimes investors have gotten used to a certain payout structure, and they expect it. And if they expect it, of course they care. We'll talk about that with something we'll call the clientele effect, which is that the clients expect a certain level of distributions or don't want distributions. So they gravitate towards funds that are either named the Rising Dividends Fund or the Never Dividends Fund. The other thing is that there are certain signals that go out to the market, which we'll talk about later when you pay dividends. But just in terms of this dividend irrelevance theory, the theory is that it doesn't matter. Because if an investor wants cash, they can just wait for a dividend, or they can sell their stock. And if an investor doesn't want cash, then they can take the dividend and buy stock if you give it to them, or if they can just be happy if you don't give them cash. Now, theoretically, there are a couple problems with this theory. Does anyone know what it might be? Why would an investor just, in addition to the points that Greg mentioned, why would an investor care financially about selling stock and repurchasing stock? There's a couple of factors.
Commissions.
Commissions. Tell us about commissions, Alex.
So every trade that you make, you have to pay. Normally, it's between 6 and 8%.
Okay, so
$6 and $8 a trade.
right. So an investor. So Ryan's an investor. He does not want cash. I give him a dividend. He says, "Oh, no problem. I'll just turn around and I'll buy more stock." He has to pay 6 to 8% to Alex. So he's kind of mad about that. What else might be a problem there?
Taxes.
Taxes. Tell us about taxes.
I mean, I guess the more money you get or you receive more cash, you have to pay more taxes.
You have to pay taxes on it. All right, and you don't want to pay taxes. Maybe Ryan is a long-term investor. Excuse me. He wants to invest in this stock for 20 years and then pay tax. What's going to happen if he has to pay taxes after year 3 because I decide to give him dividends? How is that going to hurt him financially over the long haul? He's going to have to pay taxes eventually, right? So
Capital gain tax, long term.
Okay, so capital gains, he could have to pay a higher rate. So let's talk about that really quickly. There's capital gains taxes, which if you hold an asset for a longer period of time, you get to pay the lower capital gains rate, which is, I believe, 15%. But if you have something that doesn't qualify as capital gains, like maybe Ryan has held this stock for 6 months or something, he might have to pay ordinary income, which could be, say, 30%. Does that make sense? So Ryan might have to pay a higher tax rate if I give it to him. Now what if he doesn't have to pay a higher tax rate? It's been 3 years, he's in it for the 20-year long haul. He still only pays tax capital gains when I give him this dividend. He's a little mad he has to pay Alex a 6 to 8% commission, but why might he be mad about paying taxes at year 3? So the game there is that the amount of taxes he pays does not earn a return for him. All right, so whatever he pays in taxes, that's less money in his asset pool to accumulate value. So let me take you through a quick example with that. We can see how that works. So suppose Ryan decides to invest $10 in year one in my company. And suppose I get a great 5-year run and I triple his investment. There's a 300% return over those 5 years. So suppose he is up to $30 after 5 years. Now at that point, I decide I want to give Ryan a dividend, and he has to pay capital gains. So how much does he pay if he pays 15% capital gains?
44.5.
Wait, he's got
450. You say 450? How much is that?
15%.
15% for 30.
Yeah, 450.
Yeah, well, so it's 10, or his asset base was 10, so his capital gain was 20, so he needs to pay 15% of 20, right?
Oh, it's not where the total value.
It's on the gain.
Oh.
It's on the gain. So now he doesn't have to pay income on $20, which would be a higher rate. He just has to pay a gain, a 15% gain, $20. So what's 15%?
$3.
$3? Okay, so let's see. Tax. $3. Okay, so the value is at 27. Okay, so Ryan, he got into this with the dividend irrelevance theory and says, well, I don't care. I'm just going to invest that money right back into the same stock. We'll forget about the brokerage fees he's going to have to pay Alex for a minute. So now he's got $27. Then let's say from year 5 to year 10, we have the same growth rate, 300%. So this is tripled. What is that? What's 27 times 3?
81.
81. Okay. So he's at, let's see, 81. So he's at, I'm trying to figure out how I want to do this on the board. He's at 81. All right, now. Okay, so he's gone from 27 to 81. Let's figure out the gain, and then let's figure out how much tax he has to pay and what that leaves as value. So 27 to 81, what's the gain? Somebody tell me.
54.
54, I like it. So he's going to have to pay 15% on 54.
$8.10.
$8.10.
Yeah.
Okay. All right, so tax is $8.10. All right, so what does that leave him with?
$45.90.
He's got 81.
$72.90.
$72.90.
Yeah.
$72.90. Okay. All right, so that's scenario 1. Ryan's got $72.90 after 10 years of investing. Suppose instead, all right, Ryan invests $10 in year 1. It accumulates 3 times to year 5, so that brings him to 30. All right, I do not give him a dividend. I just leave it invested. It accumulates 3 times in year 10, so that gives him $90, at which point he's ready to take it out, pay his fair share of taxes. He first has to pay a capital gains tax of 15% on the gain. The gain is $80. So what's 15% of $80? 12, okay. And that leaves him with how much? 78, right?
Yep.
All right. So he has $78 at the end of 10 years rather than $72.90. So we would rather be in scenario 2, right? So deferred tax is better. And we might really like Ryan to be an investor in our company because he's the kind of guy who's in it for the long term. He's not saying I want to sell my shares every 5 minutes. He says I've got a 10-year plan. So he's someone we might want to really keep happy. So those are the 2. So you understand the dividend irrelevance theory. That in theory, investors may not care, but there are 2 things you need to be aware of. 1 is the brokerage costs. 2 is the taxes. All right. Da-da. Second theory. Dividend preference, otherwise known as bird in the hand. This theory suggests that investors would like to have cash, potentially before you do something risky with it and bankrupt the company. All right, the dividends are less risky than potential future capital gains. Therefore, firms would like high payout firms. All right, that's the bird in the hand. That's all we need to know about bird in the hand. Does that make sense? Dividend preference theory. Third is the tax effect theory, which says essentially this, which is this part of the first theory, that investors do not like dividends because then they have to pay taxes on them, and then at the end of the 10 years, they end up with $78 rather than $72.90. So tax effect theory says that investors would like a low payout firm. All right, so we've got three potential theories: dividend irrelevance, dividend preference, and tax theory. Any questions on how those work? Let's look at some evidence that your textbook mentioned. Some research suggests that the high payout companies, and high payout companies means a dividend paying company, have higher required returns on stock. What does that mean, have higher required returns on stock? A higher discount rate. So investors are going through the analysis, determining the value for your firm. They're sitting at their cubicle doing those spreadsheets that we've talked about in the previous sessions. They're coming out with a discount rate of how much they're going to discount your future cash flows. And the higher that discount rate,
Higher the profit,
no,
higher the value of the company.
no,
It's the opposite.
Higher risk?
yes,
Higher risk.
yes. Higher discount rate, higher risk, and lower
The value.
value.
Yeah.
Yes.
What's the opposite?
So the higher discount rate they give your company, the lower value. And there is some evidence that suggests companies with a high payout, meaning they pay lots of dividends, therefore investors have to pay taxes and they don't like that, have a higher required return, and thus lower value. Other research shows that economies with less investor protection prefer a dividend preference, prefer the bird in the hand. So if you're afraid, you're in an economy where you don't have any recourse, if someone screws you over with your money, you'd rather just say, give me the money. Give me the money now. Empirical evidence has produced mixed results, so we don't know for sure which of these theories really dominates, but it is important for our analysis that we just understand them academically for a variety of reasons. When we're looking at a company and trying to determine what they're doing and why, we can say, oh, they believe this theory or that theory. All right. There is one thing that we talked about earlier, that Greg brought up, that is a thing that is important to investors. It's called the clientele effect, which means investors in your company come to expect a certain level of dividends, and they invest in your company for that reason. If you're a company that pays dividends consistently, they say, oh, yes, I like having a little consistent cash for my investment. I'm going to invest in that company. Or if you're an investor who's in it for the long haul, say I want to go 10, 20 years, I don't want to be bothered with turning around and paying taxes every 5 years, then I'm going to go with a company that does not pay dividends. And if your company changes course, say you invest in a fund called the Rising Dividends Fund, and all of a sudden they stop paying dividends, you're going to be a little upset, right? So companies, managers need to consider this clientele effect and realize that investors invest with them for a certain reason, one of them being whether or not they pay dividends. All right, different investors, firm's past dividend policy determines which clients buy in, yada yada. clientele effects impede changing the policy. So managers don't like to change the policy once they've established it. So that's the clientele effect. Let's talk about a method for determining how much a company might pay out in dividends. Your textbook calls this the residual distribution model. It uses for a basis of calculation, finding the amount of reinvested earnings needed for capital budget. So, you are the management team of a company. You're looking at your net income. All right, 2015 was a pretty good year. We've got $100 million. That's our net income. Now let's look at the next year, 2016. We've got, $80 million worth of capital budget, capital projects that we want to invest in. So let's say we have more than that. Say we have $150 million in capital projects. So you think, all right, how much of that net income, that $100, do we want to use to invest to fund those capital projects that we've got coming in? And anything that's left over, we're going to give to our investors in the form of dividends. That's the intuition. And one little thing that is a tiny bit confusing, but you'll see once we work out the example that it's pretty straightforward, is we want to think about the equity portion of that capital budget. So say you have a capital budget of $150 million. You may not fund all of that with equity funds. Suppose you're a company that's 20% debt, 80% equity. That's your capital structure. So you may fund that $150 million of capital budgeting with 80% equity and 20% debt. This will become clear once we do a couple of examples. So pay out the leftover earnings as either dividends or stocks after you fund your capital budgeting needs. So the amount you distribute is your net income minus the required equity to fund future capital budgets. And what I mean by this required equity, again, the amount you pay out in dividends, take your net income and we subtract off this required equity, which is your target equity ratio times the total capital budget. So you're not going to fund this whole capital budget with equity, just the equity portion based on the characteristics of your firm. As an example, suppose you have a capital budget in the upcoming year of $112.5 million. You are a company that funds its projects in 20% debt and 80% equity, and you want to maintain that capital structure. That's your mode of operating. That's the way the investors value your company. You've decided, because you took a finance class, that that is the optimal tax structure for you. Your forecasted net income for that year in which you have a capital budget of that much is $140 million. And you have 100 million shares. We're going to spend a little time on this example. I'm sure it's going to be clear by the time we go through it a few times. Well, let's start with the residual distribution approach. Recall that we are an 80% equity company with a capital budget of $112.5 million, and we have a net income of $140 million. So we want to find out the required equity for this $112.5 million capital budget. Because we're an 80% equity company, we're going to fund 80% of this 112 with equity. Question is, how much is that? Well, it's 80% of 112 comes out to be 90 million. So we've got a net income of 140 million. 90 million of it is going to fund our capital budget, and that leaves a dividend payout of $50 million. And if we wanted to calculate our payout ratio, should be our dividend divided by our net income. So we had net income of 140. We paid out 50 million. We are a dividend payout company of 35.7%. Pretty high, considering we just said that the average is between 26 and 28 of payouts. And Most companies don't even pay dividends. If they're going to give money back, they'll do that in the form of a share repurchase. Does this example make sense to everyone? All right, I think I left the next two blank for you, as I recall. So let's see if we can crank those out and calculate the dividend that's going to be paid, the payout ratio. I guess the dividend per share would be the dividend, which would be the 50 divided by 100 shares, which would give us 50 cents per share. So let's just, on your own, oh, Mary, get you. Oh, sorry. This is actually the only real math you'll do in this chapter. So enjoy it. Alright, anyone still working? What do we got? What do we got for the, let's see, for this one, for the net income, 0? Okay, I like that. And how about for the net income of 160? What's the dividend?
70.
Fantastic. 0.70. Obviously, for the payout ratio for 0 dividends is 0%, and 70, the payout ratio is 43.8%. Any questions on how that works? Fantastic. All right, let me have you think about this statement on the next slide. The statement is, fewer good investments would, in this model, lead to a smaller capital budget, hence a higher dividend payout. So, if you have fewer good investment opportunities, that means you're going to pay out more in dividends. The opposite is true as well. If you have a lot of really good investment opportunities, you're going to pay out less in dividends. So let's think for a moment about how the market interprets dividend payouts. We'll talk in a moment about the signaling effect of dividends. When you announce that your company is going to pay dividends, or that you're going to increase dividends, how do you think the market, the investors, respond to that? Do they think that's a good sign? Bad sign?
Do they think it's a bad sign?
A good sign.
All right, Mallory thinks bad sign, maybe? Ryan thinks good sign? Ryan, we'll start with good sign.
It's because, like you said, if you have good investments, you're not going to pay out as much. But if you have few bad investments, you're going to pay out more. So you have good investments, that's going to give a signal to the investors that you're having a lot of investments, which is why you're not paying out as much.
Okay. Okay, I think I got lost somewhere, maybe probably with where I asked the question. Probably with the way that I asked the question. And this is set up in a tricky way. Forget about the residual income model. Just think about what you knew before you came into this class. AT&T announces a huge dividend. What do you think? That's a good sign or bad sign?
Good sign, yeah.
That's a good sign. All right, the company is giving a lot of money back, right? You think, all right, so the company must be rich. often, or I'd say rarely, investors will go through that analysis and say, well, that means they don't have anything to spend the money on, so I'm skeptical. That in the real world happens less. Sometimes it does. For smart finance students like you, it might. But in general, when a company announces a big dividend, that's a good sign. Like, oh, this company's got a lot going. When they raise dividends, that's also interpreted as a good sign. Now, what happens when they cut dividends, or decrease dividends, or say no more dividends? What might investors say if all of a sudden a company that's paid dividends for years says, no, I'm not going to pay any more dividends? Yeah, it's not good. This company might have a hard time selling. All right, well, we got more investment opportunities. Well, less dividends are the rage these days. The market's going to say, well, wait a minute, you're cutting dividends? Does that mean you're short on cash? Are you going to go bankrupt next? So, in general, in the real world, in spite of all the theories we've just discussed, so we don't understand them academically, when a company announces dividends or announces an increase in dividends, the market says, oh yeah, that's good. All right, more money is good. When a company decreases or cuts dividends, they're skeptical about that. So knowing that, just sort of common sense analysis, now what do we think about using this residual income model religiously? Because if we have fewer good investment opportunities, that's going to lead to more dividends. And if we have a lot of good investment opportunities, that's going to lead to less dividends. So, it's just I've tilted the question for you, that the answer is we want to be careful about the signals that we send. We don't want to religiously use the residual model because signaling is important. And we'll talk about that, and then we'll come back to the residual dividend model. So the signaling hypothesis is exactly what we talked about. That investors view an increase or an announcement of dividends as a positive sign. They view a decrease or cut of dividends as a potentially negative sign. So managers hate to cut dividends and won't raise dividends unless the raise is sustainable. Stock price increase at the time of a dividend increase reflects that higher expectations. Management is so confident that they can give us money now, and they're so confident that they can probably keep giving us this dividend in the future. I'm excited about this company. So the bottom line is that there are some advantages and disadvantages with the residual income policy. It makes things easier. You don't have to borrow money. You don't have to sell stock just to give dividends or keep it consistent. But you don't want to follow it religiously. Unless I ask you on the quiz, calculate using the residual income model. Then you just calculate it so you know it, so you understand it. But understand the intuition. You don't want to follow it religiously all the time. Okay. Great. We're moving right along. Any questions about any of that? Let's do a couple of examples. First, we're going to go through a math example of paying out a dividend. Then we'll go through a math example of repurchasing stock. So let's suppose we want to give a dividend of $50 million to our shareholders. Suppose we have a company that is valued, our operations are valued at 1.9 million, I guess, if that's in millions. 1.9 billion, excuse me, if that's in millions. Suppose we have short-term investments, which are not related to operations, of $50 million. Suppose also this company has debt of $387.5 million. And for calculations, we know we have 100 million shares. So let's think about what happens to the value of our operations when we give 50 million in dividends. Or first, let's calculate our stock price. So our value of operations, 1937.5 plus the short-term investment. Now remember, we said short-term investment is not necessarily related to operations, but it's still cash. It's still value that the stockholders technically own. So we're going to add that to our total value. We're going to subtract off debt because the debt holders, the banks, they own a certain part of that value. What's left is what the equity holders own, which is going to be $1.6 billion. Divide that by 100 million shares. We've got a stock price of $16 before the dividend distribution. All right, so this first one on the next slide. Price before the dividend distribution is $16. So, after the dividend, we take that $50 million that was in short-term investments. We give it to our shareholders. All right, we have a slightly less, $50 million less total value. The debt value did not change, so we still need to subtract off the amount the debt holders have, which leaves us with a slightly smaller value of equity. In fact, $50 million less. We still have 100 million shares, so we divide the new value, which is slightly less, by 100 million, and we get a new stock price of $15.50 after a dividend of 50 cents. So we paid 50 cents in dividends. What happened to the value of our stock mathematically?
Decrease.
Went down by the amount of the dividend. It makes sense, right? The company was holding $50 million. That was ours, because we owned the company, and then they gave it to us. Yes?
Why wouldn't you include the short term for the after dividend?
Oh, because we used it to pay the dividend. We took this $50 million, and we paid the dividend with it.
Okay.
Yeah, so I'm the company. This is what I had. I gave you, my investor, $50 million. You now hold $50 million or 50 cents for each share that you have. And you still hold a stock, but it's worth it's worth a little bit less, the amount of the dividend. So, stock price went down by the amount of the dividend. Yes? No.
How did you calculate dividend per share?
You take the 15 million dividend distribution divided by the number of shares.
Dividend per share. Yep, exactly. This 50 divided by number of shares. So there's 100 million shares, and we give a dividend of $50 million.
Oh, the investment is different. Excuse me.
Yeah.
Yeah, okay.
Bless you.
Thank you.
All right. So stock price drops by the price of the dividend. In the real world, according to your textbook, stock price drops on an average by 90% of the dividend. So if I give you a dividend for 50 cents, my stock price doesn't drop that full 50 cents. It drops 45 cents. Why would that be? Remember we talked about signaling?
Yeah, look at the company looks better. So
Yeah, look at the company looks better. All right, when we give a dividend, the market says, wow, these management folks are excited about something that's going to happen because they think they can continue to pay this dividend consistently. So the value of my stock went up a little bit. All right, let's move on to stock repurchases and do a math calculation in a similar manner. Of course, stock repurchases just mean you buy your stock back. So you, the management, decide instead of giving your stockholders $50 million in dividends, you want to take this $50 million and repurchase stock. Reasons you might want to do that have to do with the signaling theory we mentioned. You might want to just dispose of one lump sum of $50 million that you're not going to have next year, and you don't want to get your investors used to getting a dividend every year, so you just repurchase stock instead. Alternative, dispose of one-time cash, or we might want to change our capital structure. Okay, what happens to our capital structure when we repurchase shares?
The equity go down.
The equity goes down, so we become a higher debt. We used to be a 20% debt company. Now we're a 30% debt company. All right, maybe we took a finance class and said, well, we could add some value to our company by adding debt. So let's repurchase shares.
Can the stockholders deny?
What's that?
Can the stockholders deny the repurchase?
Oh, yeah. No one has to sell.
Oh,
Yeah, sometimes there are types of options on stock where you could force someone to sell, but generally no.
Oh.
Generally, you just go to the open market and buy. And we'll talk about that in a moment in terms of signaling. which is when the management wants to buy, what happens to the price of the stock? What sort of signal does that send?
Increases, right?
Increases, right? Right. The management says this is undervalued, so I want to buy it, and you are not required to sell. So the equilibrium price might go up a little bit. I guess we're there right now. Okay. The announcement may affect price. So we, the management team, we have this $50 million that we want to give back to our investors. We don't want to give a dividend because we don't want to set up this expectation. We decide let's repurchase stock for whatever reason. And the effect that that might have on price is it's going to increase. Remember we talked a couple of classes ago that we, the management team, have the probably the most accurate information about the true value of our company. We know how strong it is, we know what opportunities are around the corner, and if we're buying stock, it might mean that we think it's undervalued. And we don't want to buy overvalued stock for sure. Right? If we think if it's overvalued, we're going to issue more stock. We're certainly not going to repurchase $50 million worth of stock if we think it's overvalued, or if we think it's overvalued. So stock price might go up once we make this announcement. And the previous events that led up to this announcement may affect the price, but the actual repurchase itself, mathematically, will not affect the stock price. And we'll talk about that. We'll just go through the same type of example we went through with the dividends. We'll see that the actual repurchase does not change the price. Essentially what we're doing when we repurchase is we're just taking a piece of the pie away. We're not changing the size of anyone else's pie that remains. Okay, so what do we got here? All right, so let's look. We already calculated these numbers. We are a value of operations, $1.937 billion. We have this $50 million sitting in our bank account, not related to operations. Total value becomes this. Debt holders are the same. We calculated an equity value of $1.6 billion. We know we have 100 million shares. We know the stock price is $16 per share. So we've got this $50 million to repurchase with. Question for you all, how many shares are we going to repurchase with this $50 million, assuming the price doesn't change when we try to buy these shares? So we have $50 million. How much?
16.
16 is the price. We have $50 million. $16 per share is the price. How many shares are we going to repurchase?
3,135.
How much, Juan?
3,125,000.
Yeah, that sounds right. 3,125,000 shares. So we used to have 100 shares. Now we repurchase, and there are 3.125 less shares, which leaves us with 96.85 shares. Now, let's look at what else happened. We'll go through this one step at a time. So after the repurchase, our value of operations stays the same. We spent this $50 million we had in the bank, so our value total is this, $50 million less. Debt is still the same, so we subtract it off and we get to $1.55 billion, which is the same calculation we had with the dividends. All right? After we spent the $50 million, our value of equity went down, but the number of shares also went down.
How did the number come to be?
This number here?
Yeah.
Remember, I asked you how many shares we get to buy for $50 million? And Juan told us 3.125 million.
50 divided by the $16.
Yeah, the share price is $16. And we have $50 million to buy them with, which means we can buy 3.125 million. Does that make sense, Patrick?
That's the that's the amount of the shares we're at.
Yeah, so 50 million.
Yeah,
Divided
divided
by
by
16 times 6. Yeah. Or divided by 16.
Divided by 16.
He's asking me about the 96.875.
That's subtracted from 100.
Yeah. So once we determine
100 million minus the 3 million.
Yeah. So we,
Okay.
does it make sense?
It's just written.
Oh,
It's
okay.
not written.
Because that's how many shares you have, 100 million.
Got it.
Yeah.
So you subtract the ones that you're buying.
So 50 million. And then what we divided by 16, right? Equals 3.125 shares. Alright, that's how many we repurchase. Alright, so if we had 100 million shares before, 100 million shares, alright, minus 3.125, we have 96.875. 75. Make sense?
Okay, I just wanted to make sure.
Good. Okay. Which leaves our share price at $16. So we did not mess with anyone else's pie. We just, as I said, took a piece of the pie away.
But you said before the price would increase with that, but it didn't increase.
Okay. Why did I say it would increase?
Because we sent a signal.
Sends a signal. All right. So I don't know. Do we want to do that calculation? Suppose it goes up. This is just the math of it, assuming that it doesn't increase. So we understand how to do the calculations. But we need to understand the intuition. Thank you for reminding us, Ryan, that once we announce this share repurchase, everyone's going to know what we know, which is this is a good buy. So everyone else is going to buy the good buy. So price may go up a little bit.
I remember 2 years ago, the company I was with had a failed merger, and the stock price took a hit. And to kind of, help, they repurchased a whole bunch of shares, and it ended up helping, the stock price.
Yeah. So management says, so the merger didn't fall. We're just happy that the share price went down, and now we're going to take advantage of this opportunity to repurchase. And everybody says, oh, well, we shouldn't have freaked out like that. Guess the stock price should go back up. All right. So what do we got next here? So key points in the share repurchase. We use the short-term investments to repurchase the stock, that $50 million. The stock price was unchanged. We just took a piece of the pie away. The value of equity fell, but the wealth of the shareholders remained. Remained directly because they now own the $50 that was previously held. Wealth of shareholders remains. Oh, yeah. So any shareholders who sold to us, their wealth did not change. But the share price, and the share price did not change. Okay. Advantages of repurchases. What do we got here? Stockholders can sell or not sell. Remember we talked about the dividend irrelevance theory? Stockholders say, well, I don't care. If you're going to try to repurchase shares, if I want the cash, I can just sell you my stock. If I don't want the cash, if I'm a long-term investor, I can not sell you my stock. It helps with investor preference. Avoid setting a high dividend. Remember we talked about repurchase could be a useful tool because you don't want to get the investors used to receiving a consistent dividend. And income received is capital gains rather than non-qualified dividends. So let's dissect that statement, make sure there's no questions about that. So when you repurchase a share, that's generally a capital gain. We talked about capital gain tax being less than ordinary income tax. Is everybody with me there? Now, sometimes dividends are taxed at capital gains, and sometimes dividends are taxed as ordinary income. Which would we prefer?
Capital gains.
We prefer the capital gains because ordinary income is much higher. So dividends, it's a sometimes. If a dividend meets certain qualifications, then you can pay capital gains tax, which is lower. But if it doesn't meet certain qualifications, I don't know all the rules. Sometimes they have to do with how long you've held the stock. Sometimes it doesn't. You just don't get to take advantage of the capital gains the way you would if it was a share repurchase. I was actually just looking on my tax return that my accountant prepared for me last week, and he just has a few bullet points that he listed, and it said some of your dividends did not qualify for long-term capital gains. I'm like, of course, it's very small. I don't make a lot of money on dividends, but so sometimes they qualify, sometimes they don't. But share purchases is a valuable way share repurchases is a valuable way to help your investors avoid capital gain, avoid higher tax. And the stockholders, as Ryan mentioned, take this share repurchase as a positive signal. Disadvantages. All right, remember we talked about one possible disadvantage that I just want you to have in your academic tool belt. It had to do with that residual income model. And I mentioned only really smart finance students such as yourselves would think about this. Can someone explain this to me? Just to recap it. This is a possible disadvantage, share repurchase. Maybe viewed as a negative signal, firm has poor investment opportunities.
I think about Dell, because I know Dell bought a lot of their shares back because I think their company was going downhill. So Michael Dell wanted to buy it back and bring the company private at one point because he wanted to restructure the company. So it could be looked at negative because they're not really performing well.
Okay.
I guess that could be it.
Yes, I think so. So everyone thought Dell was not performing well before he repurchased.
And then he repurchased.
Okay, so but once he actually repurchased, though, did they say it's even more negative?
I think the repurchase sent a negative signal because he had a repurchase in order to bring it private.
Okay. So once he did this public repurchase, everyone said, "Oh, we forgot to notice how badly Dell is doing," and Michael Dell points this out by repurchasing because it was going down to begin with. But I might, and even in that example, I teach a case on Dell about their social media for my communications class. And in that case, I would say it was more of a positive signal because Michael Dell said he knew this company was valuable and he thought it was ridiculous what was happening to it. He said, I'm going to come back, I'm going to change the company, and it's going to be worth even more. So much so that I'm willing to invest a lot of my own money to repurchase all of these stocks. The nuance here was that the reason the company is repurchasing is because they might have poor investment opportunities. They don't have anything else to do with the money. So it's only very sophisticated investors that might be able to see that nuance, but something academically we just want to understand. All right, repurchases versus dividends. Let me throw all these things out and sum them up. So the repurchase, remember the stock price does not fall, but the number of shares falls. Remember this number of shares we calculated, Patrick, 3.125 million? The number falls, but the price per share does not fall with a repurchase. Dividend, on the other hand, the price falls by the amount of dividends, but the number of shares does not change. All right, any questions on that? I think we're moving on to the next subject, which is stock dividends and stock splits. What are stock dividends? Or correction, let's start with stock splits. Those are much more common. I'm sure some of you have heard of them. A stock split. Stock split, all right? Macintosh or Apple, their stock split. What does that mean?
Apple just did it, a year ago now?
Yeah, they've done it like 10 times, right? Their stock split. Our stock split like 8 times since I bought it.
I think they did like 7-to-1, which is sort of
They did a 7-to-1 split.
Because it was $700 a share.
Oh, wow. Okay, so explain a stock split to us, please, Alex.
So the price at that point was $700 a share for Apple. They did a 7-to-1 split, so now the price is $100, but you have 7.
All right, but don't talk about price. Just tell us what is a stock split.
You're basically, depending on how much you split it, getting that many more. Like if it's 2-to-1, you're getting twice as many shares.
Okay, all right. So Mary is holding 10 shares of Apple stock. I announce a stock split, 2-to-1. I take her 10 shares and I give her 20. So I split the stock. She used to have 10 shares, now she has 20. That's what a stock split is. And Alex mentioned the example. Sometimes it might be a 7-to-1 split. All right, so if she has 10 shares, I'm going to give her 70. Mallory,
Does the value stay the same?
you tell me. Have I done anything to increase the value by giving Mary 70 shares instead of 10?
Does the price stay the same?
The price will definitely not stay the same. Because suppose Mary held all the shares. My company is worth $1 million. So she was holding 10 shares worth $100,000 each. Now she's holding 70 shares, but the value of my company has not really changed. I've done nothing to change the value of my company.
So you have more shares, but they're the lesser value.
Exactly.
So it's still equivalent to the same.
Her wealth has not changed. Stock split doesn't do anything to change the value of shares.
You just have more shares to
Yes,
distribute.
isn't that great? You have more shares. Everyone want more shares. Yes, right.
I've heard of reverse stock split, where actually they will take like 2 for 1, so that you give them 2 and you get 1 in return.
Okay.
I've heard of that. I don't know what's the real difference, why they would do that.
If the price is really low,
The price is really low.
if you're like under $1, you'll.
Okay, we'll do a reverse split. All right, let's talk about that in a minute. But let's just stay on this stock split idea and get used to what that means. So it doesn't change the value, right? Why would I do it? Why would I do it?
Because now
You are so kind.
someone maybe doesn't have, in my example, $700 to buy that share of Apple, but now if it's worth say $100 a share, I can maybe now afford the $100.
Okay, so it does make it easier for transactions. That is one reason. Now suppose my stock is valued at, say, $50, and I say it's time to split the shares. Now they're going to be valued at $25 each. It sends a signal, possibly, that I think the value of the shares are going to go up. Because I don't want it to get out of hand, and I don't want to have a stock worth $700, so I'm going to start to split the shares now. So it sends a signal that I think my value is going up, and also, because the value is going up, it's going to be easier to do transactions in these smaller increments. Make sense? So it doesn't do anything to change the value, but does send that signal. Stock dividends are similar to stock splits. The stock dividend is suppose Mary has a bunch of stock in my company. Instead of giving her a cash dividend, I'm going to give her more stock. Suppose I'm going to give her a 10% dividend. All right, she has 10 shares. I'm going to give her 1 more share. So now she has 11 shares. Now what does that do to change the value of the company?
Increase of the company.
Change the equity. You're giving her more control of the company. Right?
Yeah, I guess potentially, but what if I do the same thing for everyone, though? Like, every single person gets the same dividend. Doesn't necessarily give Mary more leverage.
Those are new shares or like shares the company hold?
They're new shares, yeah. And I write out new shares, I guess. And I give Mary one.
Is this like in exchange for a dividend payment? So instead of paying you cash, you give them more stock.
No. Yeah, I'm just giving her a share.
You're just giving.
I'm just giving her a share. She had 10, now she has 11. I wrote out another share and I just gave it to her.
Is this like a stock option?
No, it's just an extra share. And I'm leading you down this tricky path. Sorry, I'm leading you down this tricky path because the answer is the same with the stock split. It doesn't do anything to change the value of the company. I'm just writing another share and giving it to her. What I'm doing is I'm cutting the pie into smaller and smaller pieces, like I do with the stock split. So stock split.
Oh, but her wealth went up.
Well, suppose again she owns the entire company. Right? My company's worth $1 million. She has 10 shares. I give her 11. So she has the same company, but now she has 11 shares rather than 10.
So would that then decrease the value?
Decrease the value of the share.
It decreased the value of each share. Yes. So she has a few more shares. The price per share goes down a little bit. The same way with the stock split. If it was 2 to 1, if I gave her 20 shares instead of 10, they're worth half as much.
So what's the difference?
Okay, so what's the reason? The reason we do it is the same with the stock split, which is what? Sends a positive signal to the market. And as Alex pointed out, can break the share prices into more manageable for transaction purposes, into increments that are more manageable.
But as the owner, let's say you're the owner, which one would you prefer? to give a dividend stock, or would you prefer to do a stock split?
All right. So would I prefer to give it?
As like the owner, like is there a better path?
I think stock splits are more common because those and the investors say, oh wow, just as I was making fun of Macintosh, like, oh wow, they're splitting again. That must be a really big signal. And I've heard investors in Apple say that. The stock split again. Oh my God, yes, that's great. So okay, well it didn't actually change the value of your wealth, but it sent a signal that you were probably headed in the right direction. So I'd say stock splits are more common. They just send out more stock splits. Alright, so stock splits and stock dividends. Stock splits, say 2 to 1, yada yada, stock dividend. Suppose I give you a dividend, 10%, 10 shares for each 100 owned. Let's see, both stock dividends and stock splits increase the number of shares outstanding. So as I said, the pie is divided into smaller pieces. But unless this conveys information or is accompanied by another event, the stock price falls to keep each investor's wealth unchanged. So it is an important signal, but mathematically doesn't change the price. But might, as Alex pointed out, get us into a more optimal price range. I think your textbook suggests that the optimal price range in the market is widespread, is believed to be between $20 and $80. So suppose I'm at $75 and I announce it's time to split the stock. Investors might say, oh, the management team thinks the price is going to go above 80 and it's going to be awkward after that, so let's buy that stock. Let's buy that newly split stock. Okay. Generally occur when management is confident that something like that is going to happen. Any questions about that? Stock splits, stock dividends out.
I know this is sort of off subject, but there tends to be a lot of companies that the price will keep getting higher and higher and higher, and they won't do a split. Is it just, are they trying to appeal to a higher end clientele? You know, you have more money to spend, so maybe you're gonna.
I think they might be. They also might just say, on principle, we know that stock splits don't change the value of the company, so we're not going to mess around with that. We know our investors are sophisticated like that. But technically, I think there are ways to do that. That if you want to buy a stock that's worth $400,000, you go to a broker, and the broker has worked out some deal. I don't know exactly how that works. Maybe you buy a tenth of the stock or something like that. There must be a way to do that in terms of transacting.
I always wondered, if the price is over $1,000 a share, why don't you split it and then you can get into the optimal?
Yeah, I think Warren Buffett was famous for never splitting his stock.
I think it's up to like 15,000 a share.
Okay, so one
not
stock.
That you can buy it, but
right now you can buy it, but he's never split it. Yeah. Okay, so maybe we can get Warren Buffett in here to answer some questions about why he's never split the shares. All right, so the last topic we'll talk about is a dividend reinvestment plan called DRIP. Now, this is the situation where a company may or may not pay dividends. Maybe they pay them consistently. But there are some investors who do not want dividends. They want their dividends reinvested in the company. So, if I pay dividends to my investors, I might set up a plan, dividend reinvestment plan, where they can automatically reinvest that money back into the company. Now, this is convenient for my investors because a lot of them don't even know or care that they're getting dividends, and the last thing they want is some check for 75 cents that they have to figure out what this means when they're trying to do taxes. And often I can sell them those shares or get them to buy those shares at a wholesale rate, so they save a little money on the shares they're buying. So that's good and that's convenient. But there is one problem that we talked about earlier in class. Anyone remember what it is? So, yeah, does anyone remember what it is? I'll stop there. There's one reason investors might not like that.
You have the dividend? Yeah, because the price is tax. You want long term.
Yeah. So they're paying taxes, and a lot of times they're paying taxes without even knowing it. They say the company has an automatic dividend reinvestment plan, so if you don't want the dividends, you just reinvest them in the company. So if you're a sophisticated investor, you're an investor who has a large asset pool in this company, it could make a difference. But typically most individual investors don't think too much about that. They don't think, oh, after 10 years I'm going to have a slightly increased interest rate. We as finance students definitely want to understand this concept, but most companies that have a dividend reinvestment plan and most investors that are invested in those companies think it's great. They think, oh wow, I don't have to worry about dividends. I just have the dividend reinvestment plan, it goes right back into the company.
It's very convenient.
But you still have to pay taxes on it
Yes.
every year. You
Yeah.
get a statement every year.
Yeah, you have to pay taxes or your accountant pays taxes and sends you a notice like mine did that not all of your dividends qualified as long-term capital gains. And I just looked at that and like, I have no idea what that is or where that came from, but I guess I paid ordinary income rather than capital gains on something. And if I were a really smart, sophisticated investor at that level, I would say, oh man, if I had just left that money in the company or the company hadn't paid me dividends, then I would have a little bit extra 10 years from now.
Most of the time, the company doesn't really pay any attention to your tax consequences. If they're going to pay dividends, they're going to pay dividends, and they're not really going to pay any attention to whether or not the clientele is going to want to pay taxes.
Okay, so, all right, so that can work most of the time, some of the time. All right, in Greg's opinion, that's what companies do most of the time, and I would not disagree with that. But you know, we've talked about some extreme examples. Well, ultimately, if you can't keep your investors happy, then you might have problems with that. If you have a very strong clientele effect, and your investors really get mad, maybe it's a pension fund that's investing a huge amount in your company, and they're very savvy investors, and they're thinking 10, 20 years down the road, and you pay them dividends when they don't want you to pay them dividends, that could be a problem if they own a big chunk of your company. But to your point, Greg, yes, I would agree with you that companies don't necessarily look at individual investor needs when they think about paying dividends. So stockholders automatically reinvest the dividends, yada yada. Two types of plans, one open market, the other is new stock. Open market essentially means that the company will take this money they would have given you as a dividend, say it's $50 million in our example. They'll take that $50 million, they'll go to the open market, buy more stock, put it in your stock account. Issue new stock means that they will keep the money and write you additional stocks. Open market plan, yada yada, wholesale, brokerage costs are reduced by volume. Convenient, easy way, as Alex pointed out. New stock plan, they're going to keep the money and use it to buy assets. Usually they'll give you a little discount on the shares that they sell you. Also convenient. Firms that need equity capital use new stock plans. Firms with no need for equity capital will just buy stock on the open market. Most NYSE listed companies have a dividend reinvestment plan. Any questions about any of this stuff? Dividend reinvestment plans?
I have a few of them. They're really convenient.
Yeah.
I check it, every so often, and it just every time there's a dividend.
Yeah, and me too. As the example I pointed out, I didn't even know I got a dividend, but until I paid taxes on it. As always, I'm available to address any questions from the homework or from the last week's quiz. Otherwise, I'll look forward to seeing you next week. I think we're going to talk about leasing. Fun stuff. Capitalized leasing, operational leasing, fun games that we can play as management to lease rather than borrow money. All right, so I'll see you all next week. Oh, yeah,